Amara Raja sees a sharp margin improvement in the second quarter. The battery maker says demand remains robust across categories. Also announces the setting up of a lithium-ion battery manufacturing subsidiary.
And it's a weak quarter for Ajanta Pharma's high raw material costs, freight costs, as well as price erosion in US generics result in a 900 basis points hit on the company's margins.
Siaram Silk reports a strong quarter in the second quarter. We have revenue surging to 32% while profit growing 50%. The stock surges nearly 15% in trade.
IEX October updates indicates a 13% year-on-year drop in volumes, a high base and reduced renewable energy certificates. That's what's contributed to the decline.
SKF surges after a strong show in the second quarter as the margin grows and profit surges, while luxury watchmaker Ethos too rallies after record EBITDA, profit and revenue numbers for the quarterly numbers. The management will join in to discuss the numbers later on the show.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangala Malu. Mangala, we need to pull through a few hours before we head off into the weekend. But before that, we have a couple of managements as well who are joining in on the show. Elecon Engineering, they delivered a solid set of numbers in the second quarter. The profitability as well did jump up by more than 80%. Earnings were largely aided by growth across segments. To break down the numbers for us and tell us what it means for business going forward, well, we're joined by the Chairman and MD of the company, Mr. Patel. Hi, Mr. Patel. Good morning and thanks so much for joining in. Well, you're walking the talk. You've given us some guidance for the year, and it appears, at least as things stand, you're on course to achieve it. Given that you have such a good first half of the year, do you want to revise the guidance? I mean, is there an upside risk to that revenue guidance that you've given?
No, we will continue with our targets as we see that we are going towards it very comfortably. But we would like to make sure that we have solid next year also.
So 1,500 crores for this year is a given?
Yes.
And 2,000 crores for next year, right?
Yes.
All right, we take that point. Mr. Patel, I'm just looking at your order intake as well. For the first half of this year, it's been a total of around 838 crores, about 100 crores in your material handling business, looking at 750 crores in your gears business as well. What kind of order inflow do you expect in the second half of this year? And I ask this particularly because a large part of your, geographies, export geographies, are facing some sort of economic issues.
Yes, the foreign entities, because of the high energy cost abroad, are facing some challenges. However, the inquiries on hand are quite high, and therefore we are hopeful that we will be able to increase our order inflow even from the foreign entities. So apart from that, there is a robust order inflow on hand from the domestic market, and we see that there is a good possibility that we will be able to reach our next year's target very comfortably.
So could you give us a sense of what kind of order inflow are you expecting in the second half of this year? It's about 850 crores in the first half. And if you could split that up between your gears and material handling business.
Material handling was about 94 crores and there was 744 crores. We have at present pending orders of 714 crores. And we expect a similar kind of situation by the end of the year.
Okay, so, but what is the order inflow target for the year, sir? That's what you're trying to get at.
The order inflow target for the end of the year would be about 750 crores.
So from 700 crores, 750 crores more order inflows in the second half of the year. Are we getting that correct? Okay, got that. Another point that I'm noticing in your presentation is, Mr. Patel, is that for business from Navy, I think that's a growth driver for you. That's offers a lot of potential. Could you tell us currently how much of your revenues come in from the Navy? And going ahead, do you see a huge scope for that to increase?
Navy goes through projects, which means that they come and go, and in between there are quite often gaps.
Okay.
Therefore, it is very difficult to ascertain what it would be. However, what we have realized now is because the government is spending large sums of money on defense sector, we believe that there are a large number of projects which would be announced very shortly.
Okay.
And we are hopeful that a sizable part of them would come out.
Okay. Would you give us a number of how big that opportunity could be for you in particular?
It would be difficult to say, but I would presume about 200, 300 crores annually should be the potential going forward.
All right, we take that point. And in your material handling business, I remember you saying that, you're targeting about 200 crores coming in from that business annually, and that can actually go all the way up to 300 to 400 crores. Can you give us a sense of where that number is likely to stabilize?
We are planning that we would also diversify into other areas in future years to come. However, right now we see that the potential would be close to 400 to 500 crores.
By when do you get to that mark, sir?
In about 2 years.
In 2 years. So by FY25, we'll say that this material handling business that's currently going at a run rate of around 55 crores odd, it'll start doing a run rate of close to around 100 crores per quarter. Are we getting that correct?
Yes.
Okay.
You're absolutely right.
All right, fair number. The fact that you're guiding for such large numbers, Mr. Patel, there could be some capex as well that you'll have to incur, right? I think you're virtually debt-free as of now, and you've given that you're going to be debt-free, I think, in the next couple of quarters. Now there's a small debt, I think, that's there in your books. What is the capex spends? Break it up for us, and what could be the asset turn on those capex spends?
This year we are spending about 100 crores. This is entirely from our earnings. So there is no borrowed funds for this.
Okay.
And going forward, we would be only requiring some kind of bridging equipment, which would not exceed approximately 100 to 150 crores on an annualized basis. We have spent this year 100 crores, out of which a sizable amount has been invested for putting up solar plant for generating our own electricity.
Right. You've given us a standalone revenue target of 1,200 crores this year. 1,500 crores comes in from consolidated business. You've given us a standalone margin target for this year at 24%. But you haven't given us a consolidated margin target. I mean, I just wanted to understand, because overseas business, may also get an impact because of the currency, etc.
I would say the consolidated EBITDA margin would be around 22%.
22%. All right, Mr. Patel, you briefly mentioned about some solar plant that you had spent some money on, and that will give some savings, I'm guessing. If yes, could you quantify that amount?
Approximately 15% would be the saving overall. 70% of our electricity generation would be coming in from renewable energies.
70%, 70.
Yes, 70.
And
because we also have windmills, which we have installed some time ago.
All right, we take that point. And where do material handling margins stabilize at the 500 crore mark that you're talking about? Because that has been a bit of a drag on your overall margins as well, right?
Yes. We believe that an EBITDA of 14 to 15% is where it would stabilize at.
Okay. All right. Thanks a lot for joining in, Mr. Patel, and giving us the outlook on the business. That is Elecon Engineering, maintaining their 1,500 crore revenue guidance for this year, giving a 22% consolidated margin guidance for this year as well, and believes that Navy business could be almost 200 to 300 crores in terms of annual revenue going forward for them. With that, we'll step into a short break. Actually, before we do that, let's also take note of a few ideas for profit coming in from our colleagues at Money Control Pro. Nitin Sharma joins in with a stock.
MapMy India's second quarter revenue saw strong growth driven by the G-Trophy and the better than expected show by Consumer Tech and Mobility division. On console basis, G-Trophy contributed around 12% of the revenue, but at the cost of margins as device sales eroded 750 bips from the EBITDA margin. Other than this, company has started ramping up on the marketing spend, which stood at 5% of the revenue and likely to be around it in the near term. G-Tropy is expected to impact the margin for up to 2 years, but will also help the company maintain its high revenue growth and later add on to the profits via SaaS offerings. MapMyIndia managed to sign on a large four-wheeler EV OEM this quarter. Despite margin slippage, we estimate that the EBITDA margin for this year should be around 44% and then expand to 46-47% FY24 while still maintaining a 30-35% revenue CAGR. High margin and strong return ratio along with the growth trajectory gives us confidence that the FY24 P of 45 times stock is still a good investment bet in the Indian tech space, and any correction in the stock is an opportunity to build position in this stock. We recommend investors to buy this stock.
All right, thanks a lot for that, Nitin. For the time being, we'll slip into a short break. But up next, we'll get chatting with the luxury watch retailer, Ethos. The management will be joining us to detail their numbers.